Mayuresh Joshi, fund manager at Angel Broking, is now with us. Mayuresh, what's your view on the markets? You think that at 7,800 we are, fairly valued, or do you think that you need some more global data, especially from China, before we can conclude that fund flows will start back to emerging markets?
Afternoon, Pankaj. I think from a valuation perspective, I think we are reasonably valued at this point of time. So clearly, if one really takes cognizant into account of how corporate earnings are panning out and how they're expected to pan out FY16, FY17 onwards, our own take is that the markets seem reasonably valued at this juncture as well. So clearly, I think coupling that up with what is happening globally and the uncertainty around the Chinese data still lingering on global markets, clearly being reflected in how the currencies are behaving. Our take is that further softness in the market is not ruled out. Having said that, I think very difficult to predict how and when a bottom can be formed for the market. But clearly, I think another 4-5% correction onto the markets from the current level, I think the valuations will become much more attractive at that point of time.
Right, but do you think if somebody wants to invest or has some money on the sideline, a little bit can be started to park in the market? I mean, at least 10%, 15% can be parked in right now at these valuations?
Oh, absolutely. I think incrementally 10-15% can be parked at the current level because, as I mentioned earlier, I think we are never really sure on the process of the market bottoming out. And clearly, I think if you look at a few data points, I think the kind of capex that the government has front-loaded for this fiscal year, I think those benefits will start accruing in the second half of this financial year. And you'll see substantial order flows probably coming through across various sectors, whether that be roads, highways, infrastructure, power ancillaries. So clearly, I think that is going to have a telling effect on how the order block is going to move within the system itself. And secondly, I think couple that up with how the raw material or commodity prices have gone down. So whether it's crude, ferrous metals, non-ferrous metals, all these prices have seen a significant amount of correction, which will abet margin expansion of a lot of companies consuming these commodities in the second half. So clearly, I think Q2 in terms of earnings are expected to be still muted and soft. You will still have uncertainty over the next 2 to 3 months on what happens with the Fed, what kind of data comes out of China, how the monsoons pan out in India. And I think with that kind of a scenario in the backdrop, I think, and if the market's correct, I think incrementally 10-15% for long-term investors, I think definitely should be put in on any decline that they see in the markets.
Do you think that Fed hiking rate by about 25 basis points is factored in right now with the recent correction, the recent outflows that we have seen, or you still think that that will be a very big event if they actually hike about 25 basis points?
So clearly, Pankaj, I think if and when the Fed does hike with whatever proportion that they intend to hike, I think largely the markets are factoring in minuscule hikes to take place, and largely the markets are factoring in that the Fed hikes would probably happen after December, seeing the bloodbath that we've seen probably in the emerging market scenario. And again, I think Europe is just stabilizing, so I think the Fed would, if they take a move of even a 25 bips hike, I think that will happen in December. That is largely factored in. Secondly, I think on the day that it happens, you are going to see some amount of sentimental impact. So I think it's not something that we can wash away our fears with. I think you will see some sentimental impact. Maybe that will last for a day, 2 days, 3 days, a week. But again, I think that impact will come through if and when the Fed hikes rates and when they do that.
Do you think metals is a pack that one should look at? All the metal names are doing very well today, 6 to 7% plus for each of these names. Is there any value over there, or earnings downgrade would tend to continue, or how would you look at the metal names from your own?
No, clearly, I think with the commodity down cycle, the earnings are going to take a huge hit. So I think it has already been indicated by a few companies that they are going to take a hit on earnings. And it's going to be an obvious reasoning. I think the kind of realizations that one really expects from core metals or commodities have fallen down drastically on a year-on-year basis, even on a comparative quarter-on-quarter basis. So sequentially, I think realizations should still remain very, very soft. And though the input costs have come down drastically as well, I think the offsetting benefits are not going to be huge when it translates into the bottom line, because the demand itself is pretty poor and muted. So clearly, I think it's one theme that looks pretty attractive on a valuation perspective. But clearly, I think the kind of cycle that we're going through, I think it will still take some amount of time for recovery to happen. For a serious earnings recovery in terms of how cash flows will pan out is still some time away, though I think valuations seem attractive. So I think I'll just wait out for another quarter to see how the commodity cycle is behaving. I think if we see some signs of an upturn happening, and that has to be backed by consistent data coming through, we will take a call. Until then, I think I'll desist from looking at commodity stocks, at least at this point of time.
Right. Mayuresh, before I just ask you the next question, wanted to point out Amtech Auto again. It's again at the day's low, 36 odd percent in terms of decline, 30.85. It's a name that has been in focus in the last 2 hours or so, and continue to track it. 10 odd minutes to go for market close. I'm sure tomorrow morning also there'll be a lot of volume, lot of activity over there. But right now, down about 36.2%, closing in near the day's lowest point. Mayuresh, any view as far as Amtech Auto is concerned at 30 rupees, or now it's an avoid because of what's happened to the stock price?
No, absolutely no views on this stock, Pankaj. But if you look at the auto and the auto ancillary pack, generally, I think we'll still be preferring the four-wheelers at this point of time. With the kind of beleaguered monsoons that we've probably witnessed, you are going to see some amount of degrowth seeping through, at least on the two-wheeler side. And a major chunk of the volume probably come through from the rural and the semi-urban areas. Having said that, I think even the four-wheelers will probably take a hit, specifically on the semi-urban side. But something like Tata Motors is looking extremely attractive to us at this point of time. I think valuations are looking seemingly low at this juncture. And again, I think the kind of strategies that Tata Motors has in place, specifically with their modular strategy, platform strategy coming through, the Chinese JV, the Cherry plant, the operating leverages should start coming through. New launches should start picking up steam. And I think the markets are largely factoring in the slowdown in China and Chinese volumes as well. So clearly, I think Tata Motors is something we're liking. Couple that up with Maruti Suzuki, where we believe that the volume should hold on for this major. I think the product mix is quite right. Discounts have come down. The market share has increased over the last few quarters. And again, I think the realization per vehicle because of a better product mix is better. Yes, I think the yen depreciation or depreciation over the last 3 months, I think that will have some amount of impact as far as the EBITDA margins are concerned. But a lot more localization has gone in for Maruti over the last few years. So that will also create some amount of cushion. So Maruti on declines and Tata Motors probably at the current juncture are appearing good, decent bets for a long-term perspective from the auto space.
Do you think that the street is factoring in a lot as far as Tata Motors and the JV, the decline in China is concerned? We are already factoring in a decline in terms of volume, which may not be the case when we get the data going ahead.
No, clearly I think the pain would still continue. If you've gone through the annual report and what the management commentary was, that FY16 is going to be extremely torrid for Tata Motors. So I think in terms of even the margins on a consolidated post JLR ex-China, I think even though the volumes have held up pretty well, on a consolidated basis, JLR margins and EBITDA should come down for the better part of FY16. But again, I think it's an entire theme that you're probably playing. You're getting Tata Motors probably at 8.5, 9 times FY17 earnings. Cash flows have been pretty strong, even though the Chinese slowdown has been quite impactful on its overall volumes and EBITDA. But clearly, I think with new launches coming through, and our own take is that we've actually cut down estimates in terms of how earnings will pan out. And we've actually cut down our estimates in terms of how volume degrowths will happen for JLR. And even we've discounted a little bit on the domestic side as well. So higher depreciation expenses, volume cut down at our end. We are cutting down our EPS estimates. But clearly, I think the operating leverage benefits from the Chinese plant, the JV operations with Cherry is going to impact Tata Motors JVs in a significant manner, because it's going to have a significant amount of import duty savings as far as the Chinese plant is concerned. And clearly, I think if you're looking beyond FY17, I think the earnings should rebound in that time period.
Right. Mayuresh, just stay on with us. I just wanted to play out an interaction that we earlier had with Leo Puri. My colleague Ramya Dharmarajan caught up with Leo Puri, MD at UTI AMC. Let's listen in what he told us.
What is the view on markets from here on then? Like, what do you...
The only certainty is that we have a period of prolonged volatility ahead of us, given where the global economy is at this point. Yeah. We will continue to worry about how the global monetary imbalances are going to be adjusted, and we will continue to have to worry about the slowdown which has already occurred in Europe and the slowdown which is beginning now in China as well. These are very major factors that are going to influence what we do. The best thing we can do is keep our own shop in order, manage our own macroeconomy, which we are doing through fiscal imbalances, bringing the fiscal imbalances down, managing our current account deficit, doing our best to manage the rupee to the extent we can, but most critically indicating that we are open for business, ready for reforms, and that we are a very attractive destination for the world to come and do business. Both the external environment and our own businessmen in India need to feel confident that this is the best place in the world in the current environment to actually launch and put capital to work.
Is the dip in markets a buying opportunity then?
For retail investors, I would hesitate to give that advice. I think for a retail investor, it has been said, and I will restate it, you must buy systematically and you must buy in a stable, consistent way. Whether you use a systematic investment plan, timing the market is really not something. I'm not an astrologer or a pundit, and I'm very skeptical of people who offer advice on channels, including yours, with great certainty. I think they have no more knowledge about this than they would about betting on a horse on the track. But I can say that for those who are willing to take the 3 to 5 year view, all the evidence supports the fact that equities will continue to outperform other asset classes. They will outperform inflation. And we have a very good chance in this country that we will relatively outperform the many other countries or many other asset classes that are going to be available to us.
So you expect India to be a best performer once the things get settled?
I think we will be among the best performers. When you look back 3 to 5 years from now, I think you will see that India has been an outperformer over that time frame.
Do you expect FII's outflows to be as bad as 2008, or you think things will get managed?
No, I think we have to be extremely wary of the fact that in an environment which is nervous and anxious as we have today globally, FIIs will be skittish. We cannot take them for granted. They need to be wooed. They need to be convinced that we offer an opportunity. They will look at earnings growth. They will look at the direction of reforms, and they will make them. They certainly should not be taken for granted. And equally important, therefore, that we develop domestic capital markets alongside that.
One last question. What are your thoughts on infra? Industrials can make a comeback?
I think the planned government expenditure is one good sign, and I think that will certainly help the industrial sector. And I think the resolution that is happening in terms of stressed assets within the banking system will be another stimulus. So yes, it's going to take a little while to digest this. I don't anticipate anything happening in 3 months or 6 months. But again, in 18 to 24 months, I think you will see a turnaround in the infrastructure sector.
Thank you so much.
Thank you.
That was a view coming in from UTI AMC. They run one of the largest money here in India. 110 odd points higher for the Nifty, about 90 seconds, less than about 90 seconds remaining for closing. And one would have to say that this has been a good day. At a point of time, we did get a scare to go down and down below the 7,800 mark. But now it's quite certain that the closing will be about 7,800, 110 odd points higher. And it's decent close. Volumes are low. We'll have to wait and watch as to how things go. But it's looking in good. And every time when you go in or come out from an oversold region, the bounces are like that, with low volumes, very, very low interest, high beta doing well. But then follow-up buying has to come in to confirm that that was the bottom. BHEL on your screen went towards 215, but 2.5% higher in the end. Idea Cellular was the only meaningful loser in the Nifty 50 pack. Bharti, on the other hand, was up 1.1. Coal India flat with a positive bias, about 2 rupees higher. Yes Bank up about 12 to 13 odd rupees. HDFC Limited was one of the top losers yesterday. Today up a good 45, 46 odd rupees. Reliance up 6 odd rupees. Kane India up close to 8.5, 6%. It was the top gainer. Tech Mahindra now slowly inching in towards 545 odd levels, 1.5% higher. Kotak Bank 2.7% higher, 16 rupees as far as Kotak Bank is concerned, and Tata Power up close to about 2.5 odd percent. Tata Power had gone to the levels of 56, and that was a big question mark as to how things would go ahead with most of the analysts. But now it's trying to come back. TCS up about 0.5%, NMDC up about 3, HUL up, Lupin down about 14 to 15 rupees. IndusInd Bank up 4%, 854 rupees for IndusInd Bank. Asian Paints up 2.5%, GAIL up about 1%, Wipro up about 2.5%, Maruti up 2.8%, Bajaj Auto up close to about 2.3%, ACC up about 2.9%, Amtech Auto down about 16 rupees, Ultratech Cement up 4%, Dr. Reddy's up 0.25%, Grasim, it went ex-dividend also today, and that's why it was a decent close when it was on the upside. Amtech Auto really the stock of the day, down about 35 odd percent, Kaveri Seeds down about 5 odd percent. These are notable mid-cap names that really lost out. They were in focus in the full full August series, and now again they have started this series on a similar note. Very difficult to justify whether we would see such a fall in these names, but this is always something that starts this way. Castec Technology up down about 5% as far as a mid-cap loser is concerned. NTPC on your screen, it went to the lows of 116 yesterday and then it came in as a buy, but now it's at 117. DLF 10% higher, 121, again one of the strongest movers today. Oberoi Realty 6.8% higher, 244 for Oberoi Realty, 2.5 lakh shares in terms of trading. Unitech up 3.36 odd rupees higher, at about 6 odd rupees. DB Realities 4% higher, 55 rupees. Puravankara up about 1.3, 64 rupees for Puravankara Limited. Volumes very, very low, but the entire real estate pack, whether they had debt, whether they did not have debt, did particularly quite well today. The real estate pack was in focus. Private banks were in focus. Jet Airways on your screen up about 2.5 odd percent, 325 for Jet Airways. Look at the volumes, 1.5 million shares, and it's a good volume when we look at Jet Airways. Off late, there has been a lot of interest in Jet Airways. Every time it goes down, it does tend to see some sort of buying. Let's look at some of the other names. So DLF, we spoke about it. JSW Energy was up 7%. That's another name which the street has been talking about, that how from 110 it has suddenly gone to 65, 70 odd levels. Today bounced back by about 7% or so, 74 odd for JSW Energy. Birla Corporation, I think there was some news flow regarding this name. Volumes were very low, but still up 5% towards the close. Birla Corp, 454 rupees. JB Chemical was up about 10%, 287, and a lot other mid-cap, small-cap names were doing well throughout the course of the day. We were talking to Mayuresh Joshi. He is still with us. Mayuresh, just a word on the closing. We've not given up the gains in the last 1 hour or so, which was generally the trend that we saw. You think ETF flows, largely the worst is behind as far as ETF outflows are concerned? Now the outflows may not be as big as we've seen in the last few days?
So not really sure on that, Pankaj. So clearly I think one really needs to take into cognizance how global events shape out to be, and nobody's really sure on what will happen globally. So clearly I think with the Chinese market shut for a couple of days, you're seeing some amount of respite on that front. But again, I think one really needs to understand how the macro picture is playing out, which is not looking very encouraging as far as the global scene is concerned. And again, on the domestic side, I think all the concerns that we flagged off, I think that needs to be addressed over the next few months. So clearly I think the markets would stay in range, but whether this uptrend would continue, I think that has to be seen over the next 3 to 4 days.
Do you like private banks now with what HDFC Bank has done in terms of cutting their base rate aggressively, or you would want to take a note of the results and probably then take a call on them, because they've sold off quite a bit after HDFC Bank cutting off the rates aggressively?
So yes, I think clearly, I think it might have some amount of impact and some kind of a base rate cut war happening between the banks. But clearly, I think it would be not price diluting or value eroding in our sense. So clearly, I think after the correction that we've seen on a lot of these private sector banks, valuations are extremely compelling at this level. Clearly, I think all the parameters that one really needs to understand, I think the private banks tick all the check boxes. So whether that be capital adequacy, asset quality, return ratios, branch network, fee income, credit growth, I think every parameter is probably taken care of on a much better scale compared to the public sector counterpart. So I think the valuation gap that you see between the PSU and the private side should hold, and the bias remains with the private side. So yes, I think to answer your question, private players, specifically on the banking side, I think they seem attractive to us, specifically after the sharp correction that we've seen on the stocks.
What's your view as far as cement pack is concerned? We also had an upgrade coming in from Nomura on Ambuja Cement. It was up 4%. Do you think cement is looking attractive after the correction and one of the best plays for India infrastructure recovery?
So clearly, I think it is one of the better plays when you talk about an infra-led growth happening in the country over the next 2 to 3 years, and cement will be a key contributor to that. Having said that, I think over the past few quarters at least, I think it has been more of a belief of things happening on the ground, which are still not happening, because I think we're still struggling with capex coming through, which is clearly being seen on utilization levels across the sector. But again, the take is that once these reforms start getting implemented, as I mentioned earlier on your show as well, the government spending on the plant side has been quite significant for the first part. And since they've front-loaded that, I think a lot more can be expected on the infra side, road side, highway side, power side, to come through in the second half of this fiscal, which will benefit the cement sector in a huge way. So our own take is for the overall sector, utilization levels picking up significantly over FY17. The realizations are soft, but we again expect realizations to stabilize and pick up slowly and steadily over the next few quarters. With raw material prices and input costs staying benign, the margin should also show some meaningful take, which will affect very, very effectively on how the return ratios pan out. So clearly, I think as a theme, we do like cement as a sector. Within cement, I think mid-cap cement is something that we are liking at this juncture. So JK Lakshmi, JK Cement is where we believe that the value growth will pan out over the next couple of years.
Mayuresh, thank you so much for joining us here this afternoon. Always a pleasure talking to you. That was a view coming in from Angel. Very, very bullish as always on some of the names, but saying that markets, could be quite range bound and things need to be watched going ahead. We're taking a break. Coming back into another key thing that the market, except the Chinese, the global factors that